I'm Charlotte McLeod with investingnews.com, and here today with me are Kevin Wadsworth and Patrick Karim of NorthstarBadcharts.com. Thank you so much for being with me. Great to have you.
Thanks for having us back on, Charlotte. It's been quite a while, hasn't it?
Yes. It's great to have you both back. I was looking back before I came to the interview to see when we last spoke, and it was almost exactly a year ago. So definitely we have a lot to go into. And one of the concepts that we talked about at the time was the capital rotation event idea. And essentially you were showing that there were all these different boxes that had to be checked off before that was confirmed. So I thought we could start there, get an update on what's going on. Have all of those boxes been checked off at this point?
Okay. Do you want me to go through this, Pat?
Yeah.
I can do. Okay, right. Well, I'll put my screen sharing on so that you can see what I'm looking at here. And what you're referring to there, Charlotte, is the capital rotation evidence. And when we spoke to you a year ago, not all of these boxes had turned red. We first sort of developed this matrix about 18 months ago now. And one by one, these boxes have gradually been turning red. What they represent is whether the thing that's in them is in a bear market priced in gold or not. So you can work your way through them and look at them. We've got US money supply there. We've got the US dollar index. We've got consumer prices, producer prices, currency in circulation, the equal weighted S&P, the New York Composite Index, the Dow Jones, the Wilshire, the Russell, the S&P, and the NASDAQ. So all of those now are in well-defined technical bear markets priced in gold. Now, any one of these boxes can turn red at any point in time and enter a bearish period priced in gold. But by using weight of evidence, what we start to develop is a more comprehensive and accurate picture of what the heck it is that's going on at the moment. So, why is crypto and Bitcoin plunging? Why has Bitcoin just fallen 50%? Why has crypto total market cap not made a new high priced in gold in this most recent bull cycle? It completely failed to do that for the first time ever. Why is silver going bonkers? Why are all these things happening? Well, it's all tied in with a rotation of capital and a capital rotation process. So one thing we need to make clear is this is a process that takes place, and what we refer to as a capital rotation event can only really be seen with hindsight. You can only really say, that was the event, once it's kind of already pretty much a lot of it has actually happened. It's something that you can define and look at with hindsight, but the process that's taking place that leads to an event, and the event is the stock market falling substantially, and by substantially I mean sort of 30% or more, then that is the event, and you can only sort of see that with hindsight. And this has happened 3 times in the last 100 years, and this is the 4th time. So we can see what happened in the example in 1929, 1930. We know what gold and precious metals and commodities and energy and oil did. We know what happened in 1972 when it happened again. And we know what happened in the early 2000s when it happened again. All of these boxes turned red. And what happened was, in a nutshell, the stock market went down, it went up, it went down, it went up. It did all sorts of things. But over a period of 10 plus years, it didn't go anywhere. So from the start of the event to the end of the gold bull era, the stock market went nowhere for 10, 15, 20. In the case of 1930 there, I think it took something like 24 years for the stock market to get back to where it was originally. And even in the early 2000s there, it took well over a decade for the stock market to get back to where it was originally. So however the stock market difficulties present themselves, whether it's one huge plunge like it was in 1930, or whether it's a series of drops like it was in the 1970s that eventually culminated in a drop of 50%, however that process unfolds, it's a case of the stock market really, not being particularly attractive for a period of 10 years, whilst gold, silver, commodities, energy and oil move up by hundreds and in some cases thousands of percent. So it's no surprise to see what's been going on with gold. And you can see on the gold chart here precisely what happened. And the event of the 1970s is shown here on the left-hand side. And the early 2000s event is also shown. Curiously, from the ending of the Bretton Woods Agreement, the move was about 645%, which interestingly was the same size as the move between the bottom and the top in the bull market in the early 2000s. And just interesting to note that if you do some technical analysis on this using Fibonacci levels, 645% actually takes you to around about $8,000. So it's going to be interesting to see just how we progress through this period towards $8,000 and very possibly beyond that. And in fact, there are many technical sort of techniques that give a target area well in excess of $15,000, $16,000, something like, let's say, about 8 years from now. So we have to take it one stage at a time, one step at a time, and realize that both gold and, this is the silver chart, have had massive sort of vertical moves just very recently. So, you can't say that entering now is, a perfect time to enter the market if you weren't sort of following our guidance a year ago, 18 months ago, and you're just sort of, starting to listen now, then, this isn't the best time to take a position, particularly if you're trading or if you're a short-term investor, because there's a risk that you're going to find yourself in a loss-making position, at least temporarily. And in fact, we moved up to $121 for silver, and then all the way back down to somewhere like, was it $64 or $67? So, had you entered at $90 plus, you'd still be in a loss-making position right now. So, how you define an entry point is important, and how you define whether you're a trader, an investor, or a stacker is also important. Your time frame is what I'm getting at. But clearly the importance of breaking out from a pattern that's been building, massive cup and handle pattern that's been building over 45 or 46 years, this breakout here would suggest technically that this is just the beginning of a new era for the price of silver moving significantly higher in the years to come. And the weight of evidence suggests anything, from 250 all the way up to $500 plus is a reasonable expectation over a time frame of, let's say, 8 years, as I said before. So, all of this is part of the capital rotation process where gold will outperform the stock market. In fact, I didn't show you that chart, but gold versus the S&P or gold versus the Dow Jones is, in a bull market, or put it the other way around, the stock markets are in a bear market priced in gold. And that is the first sort of warning sign, Charlotte, for what may be to come next. Because when everything is in a bear market priced in gold, it's telling you something about the underlying macro forces in the underlying economy.
I think that's a really good overview to get us started. And you mentioned we've got to go step by step as we're looking at this. So when it comes to next steps that we're looking for, are we looking for that turnaround in the stock market as the next item to watch for, or how are you seeing it?
Gonna take that one, Pat?
Yeah, well, exactly. So step one is the weakness of the stock market versus gold. But all those squares there that Kevin showed you, what they're telling you essentially is the equal weighted SPX, NASDAQ, they all track the same capital flows. It could have been just one big square, which was the SPX or the US stock market versus gold, right? So now gold's in a bull market. So pretty much all those other assets which track each other, there could have been 20, 30, 40, 50 of those. It's pretty much US stocks versus gold. So step one, US stocks, they roll over for gold. So that's the chart. That's the Dow Jones Kevin is showing. So that's step one, the rollover, right? Lower highs from the 2000s, the stock market has peaked pricing gold back in the 2000s. Now it could have broken out there, that major resistance line that Kevin's drawn there, but it didn't. So that's us being objective, unbiased. If that breaks to the upside, Ken and I say, hold on, guys, the stock market is outperforming gold once again, and you should favor that instead of favoring, gold. So that was step one. But now step two is when gold outperforms, or even silver outperforms. I'd rather use silver than gold because silver back prior to 1970 was unpegged. So you have more granularity because you got to remember gold was pegged for long periods of time prior to 1970. So when you do a ratio chart of the Dow or SPX, reconstitute that, because I think even the SPX didn't exist back then, price in gold, essentially what you're looking at is the volatility in the US stock market and not really gold. So you have a ratio chart. It's telling you something, but it's not telling you the whole picture. So price in silver, price in gold. Step one is the stock market losing its ground versus silver. Then what comes after that is the stock market losing ground priced in fiat. And that's the underlying weakness right now that we see as gold's in a bull market. And you'll see in the 70s, 40s, 50s, 60s, 70s, 60s, leading up to the capital rotation back in the 70s, silver was actually bottoming and went up with the stock market. People, they always think, silver's the opposite, because they look at short-term memory where stock market went crazy from 2010 all the way to 2020, and silver went in the bear market. But they forget that after the crash of 1930, silver actually bottomed with the stock market, and they both rose up together, except the stock market was outperforming silver on the way up, which is bullish for the stock market. But in the late 60s, the stock market was starting to roll over versus silver. And shortly after that, it started having its multiple drawdowns, like Kevin said, 30%, 40%, then another 30, 40%. And every single one of those drops in the SPX after it started rolling over versus silver or gold, those are capital rotation events, all of them. It's just because right now we're focusing on the major capital rotation event, but you can make a case that even the fall in 2020, the fall in US equities back, I think in 2022, that was a ninja capital rotation event, and where that put a floor under gold and silver, because all the destruction of purchasing power required to save those US equities of that drawdown on the recovery side, that helps fuel gold, silver outperform, and it puts a floor on that. So we've had those. Now we're waiting for the more important capital rotation event, and it's those red lines there that Kevin's drawn. The steeper the line is in TA, Charlotte, the less important it is. So it's important. It's a long rising support line, but because it's steep, that means if you break it, you still have upwards momentum as defined by that steepness. The more and more slanted horizontal they are, the more important they are. So eventually you'll see that black line is going through there for SPX price in silver. We went through that, it's not really a line. It's a line, but in TA, it's only meaningful if you have 3 reactions on it, but it's still telling you that you're starting to lose that upwards momentum. And now eventually we're going to break down from a less steep support line, and that will be the kibosh there. That would be the death blow, especially if it's accompanied with U.S. equities market drawdown. That is truly, truly the key of all this, is you need a U.S. equities drawdown, whether it be 20, 30%. If you don't have that, you don't have a true capital rotation event. We're just in the process of it. But the next true leg up for silver, gold, of their true leg up of outperformance, no matter what level they are, when we have that rollover in the US equities, they happen after. So often people, they confuse us saying, well, Patrick, how come you're waiting for this capital rotation event there? How come you're not in silver? Well, no, hold on. We've been playing silver since that breakout back in early 2024, quarterly breakout, monthly breakout. We've been in gold for forever. So you still play them price in fiat. All we're saying, a capital rotation event, guys, it's not something you wait for. It's something that tells you once you've had it, then the better years for gold and silver will happen after that. So I just want to finish with this little definition here. Bull market, guys, bull market is when you go up in price in fiat. So if the SPX is in an uptrend above a 3-year moving average, price in fiat, bull market. If gold's above a 3-year, inclining 3-year moving average, price in fiat, bull market. A bull era is when you're going up in a bull market, price in fiat, but you're also going up price in your competitive major asset class. So if gold is going up in fiat and going up priced in SPX shares or priced in Dow Jones shares, now you could say it's in a bull era. And every single one of those capital rotation events you have after that or during the bull era, it's fuel to launch it. Because you got to remember back in 2008, we had another capital rotation event, right? We had one in 2001 when the markets rolled over. Then we had another one in 2008 when the markets rolled over. And on the recovery side, guess what happened? Silver went bonkers. It outperformed practically everything. Gold went bonkers, outperformed the stock market. So that's what it means, guys. Capital rotation event is these events to varying degrees. And now we're going to wait for the huge one, where especially it's probably going to be below that line there, the red, the arrow that Kevin drew. That's going to be what we call a super capital rotation event, where you're going to be breaking down from a 45-year rising support line. My goodness. It's like how do you think we're going to get $500, $800 silver? It's after that. It's after that we're going to launch from $100. We're going to do 8x or 5x. It's after that. Gold's going to be able to do 4x. Probably after that, go from 5,000 to 20,000. It's highly likely after that, because imagine, Charlotte, all the lowering of rates, the money printing, the US debt acceleration, all that stuff that they're going to have to do to save the economy, all those stimulus plans. Whatever they're doing now, they're going to have to do much more if the market rolls over, because you got to remember those US tax receipts, right? All that money coming in, those 401k plans, all that stuff. It's detrimental, to the US safety or whatever. I think we talked to Luke Groman recently, and he kind of phrased it that way. He says it's a national security priority that if the stock market rolls over, they gotta print, even if it's an illusion and they steal your wealth by, doing it, destruction of purchasing power, inflation, right? Just to keep it nominally afloat. Kevin, can you do SPX price and CPI? I just want to show them that chart, how much it lost in the 70s. So the US stock market went sideways in the 70s, right? Sideways. It didn't look that bad. But when you adjust it for inflation, it lost, I think, 80%. So let's do SPX price in the CPI. So we're not pricing it in something else that's not pricing against gold, just a regular random inflation. And check this out. That should be a big eye opener for your viewers. Drum roll, please. Look at the 70s. Look, it went down from 67 when 68 when it started rolling over, and I think that's where we are now. We're close to there. It lost, I think, 80%, 65%. It lost in price and inflation. And look at it did in the 2000s again. So that is not the SPX losing price in gold, price in another asset that's going up. This is just price inflation, and you don't want to be in stocks when they do that, guys. Once we lose that rising support line there, I'm sure Kevin's going to draw one soon. Once you lose that line, guys, you just don't want to be in stocks right there. You want to be not in the SPX, but the SPX is 11 sectors, guys. And some sectors which are underweight, like basic materials, energy, which are a small percentage, will steal some of that capital from the tech, from, whatever the ones that are highly ranked. And it's just a rotation. So there's still a long way to go before we get any type of confirmation of capital rotation event. The stock market, that red line will only break, not because CPI is going crazy. CPI, it's not going to go up crazy fast. It's the volatility of the SPX, which is going to make that crash. And until we have a drawdown in the SPX, then it's steady as she goes there. But we are on borrowed time because the SPX has already rolled over versus gold. Already rolled over versus silver. And my goodness, you're letting me rant so much. I love it. I love a great rant like that, but I'm running out of breath now, so I might have to stop talking.
Yeah, I'm just on talking about the stock market, just, to give some numbers to people. Priced in US dollars, stock market's fine. This is the S&P. And the only sort of thing that, this is kind of a rising wedge pattern, which anybody that's familiar with technical analysis will be aware that these rising wedges, when you get an upside breakout from them, they can lead to very rapid upside. It's kind of a melt-up type thing. We've seen it in gold and silver. We've seen these wedges forming on a variety of time frames in gold and silver. And people think, a rising wedge, it's bearish. It means the price is going to break down. Well, not always by any means. In a bull market, these rising wedges can be very aggressively broken to the upside. And the technical analysis, it doesn't tell you with certainty whether it's going to break to the upside or the downside, but what it does tell you is when you can act. And if you get an upside breakout, then you can become even more bullish. And in this case, because I've colored the line orange there, what we can say is that any move back below that orange line, around about 6,770, and that's really going to start the alarm bells ringing, because that kind of opens up a pathway to the red support lines there, which, comes in around about 5,800. So any movement back below that orange line, and what you're doing is you're undoing the technical breakout. And when you undo and unconfirm a technical breakout, then what you're saying is that was a false breakout, and false breakouts very often suggest a significant downside move lies ahead. That green line is a clear resistance line. So above it, above about 7,035, then that starts to open up an increased probability of a move to 8,000 or more. So, there's a number of action points on this chart. One is crossing the green line, another is crossing the orange line. And if, God forbid, we ever cross the 5,800 area, then that opens up a target all the way down at somewhere around about 3,500. So, this is what's going to help us identify a capital rotation event in real time, because should we go back below the orange line, then a capital rotation event is quite possibly starting. And if we cross the red lines, then we'll certainly be able to look back, I think, and say that was, a significant capital rotation event. And it's on the recovery side of that, once the stock market is, getting significantly lower, that you're likely to see precious metals, which no doubt will have been hit by this as well, along with pretty much everything else. Precious metals will really start to fly out of the gate. And history teaches us that on the recovery side, particularly silver, goes crazy. So should this fall significantly, as per that red arrow there, whether it's this year, next year, or the year after, then it's on the recovery from that, as the stock market is trying to get back to where it was. So just literally getting back to where it was. It's during that period of time that silver will double, and then it'll double again, and then it'll double again, and then it'll double. So, that's how you get from, maybe $60, $70 silver, if we've had a correction, all the way up to hundreds of dollars.
This is the direction I was hoping to go in, maybe talking a little bit more about recent gold and silver price activity, because we had at the end of January those big moves up, and then the pretty big corrections for both gold and silver. And I think many people saw those as an opportunity, but there's also concern about what was going on. Was this the end of the runs in the precious metals? So as we're moving into this higher upward trend, do we just need to be ready for these types of corrections, a little bit of volatility along the way? How would you put that to people who are watching what's going on?
Well, yeah, I'll show you guys how we do it, and how people could entire screen. So people have to figure out what time frame they're in this for, because what I hate to see is people that are coming they want to make a quick buck. They're coming in as traders, but then because there's a huge correction on the shorter time frame, which applies to them, and then there's a correction, and then they're underwater right away, and then they say, finally, you know what? I'm going to keep it for longer term. It's a long-term uptrend, and they decided not to follow their game plan. I hate seeing that, because that's like you don't change your game plan like that because somebody forced your hand. That means you did not respect your original game plan. So I just want to say that first. So now here's the monthly chart. So monthly chart is for, longer term people who want to hold for many years. This is how stretched the bottom pane, Charlotte, is how stretched I am from that red line, right? This is the distance from the mean. Look how high we are, how stretched we are from the moving average. 2011 top. We got the 1974 top. And the only time we were able to distance ourselves that much away from the moving average was we had after a small pause here, maybe like we're having today, we had another crazy melt up. So anybody buying right now, they're kind of hoping for outlier territory. I don't know if you guys are mathematical or you're scientific about that, or most people are emotional. So they're hoping for an outlier event. That's what people are hoping for. Anybody jumping in right here that's on the sideline is hoping for this. Because if you're not hoping for that, then you're very close to a top here. You're very close. We've done all these measured moves. Where's my copy thing there? Short bar patterns, right? This is the move we've done here. I copy that. Let me just stretch out a little bit. This is my, look, I've done it. This is like I've surpassed this move that we've done here. I've surpassed the move we've done back here. I've surpassed the 1970s move. Look, in energy in, energy out. I've surpassed that. The only one I haven't surpassed is the 1970s move. So there's on the table, you got a little bit more juice here left there, which is fine. So if you're on the sidelines and you're looking at this chart, it is just, for me, it's just mind boggling. Anybody that would just jump in here, for me, it does not make sense at any moment. The time to get in was back here on the breakout back in February, March of 2024. And that's it. If you missed that, you maybe had another opportunity here at $34, $35, but you've 100% missed it. For anybody who's already in the trade, you have a couple of options here. If you're a classical TA guy, you've probably exited already because the measured moves from this pattern, even if I take the greedy one, it's already been reached, guys. We've surpassed the classical measured moves from that big pattern here. We've missed, it's already been reached. If you're a trend follower, then you're fine, because from trend following is as long as I'm above, let's say, the 12-month moving average, I don't care if there's huge correction. So that 20, 30% correction we had here from that peak all the way down here, from a trend following perspective on the monthly chart, a longer time frame, as long as I don't have a close below that 12-month moving average, you're fine. You don't even care about, every month you check, did I close below that 12-month moving average? No, I'm writing it. A little bit here, like the 2000s. Look at that run here. Barely close. Here it closed below, then it closed back above. Here, we're always above the 12-month moving average until you get that crazy candle. The trade-off is a classical TA guy will always sell into strength and will always feel wrong. Always people get mad at you. Why are you selling, Patrick? Because to sell into strength, there's no weakness. You're selling at a high. A classical TA guy will always sell at a high, always, because it's measured move targets. A guy who's a trend follower, well, he's going to have to wait for weakness. So that's a problem with silver. Right now, if you don't sell into strength, you might get before you close below, before you have evidence that the trend is really halting or is not as bullish anymore, you might be down 20, 30, 40% before you get an exit, right? So that's the trade-off. People have to know what type of trader they're going to do before they enter the trade. And that's my biggest message I could put out to people. You got to figure it out before. But right now, when I look at the silver chart, even if it rockets up here, Charlotte, it's still not a good idea to jump in on silver right now. I know people, they want to jump in, but it's still, from my perspective, you enter here, you enter maybe here, but that was your last shot. You don't enter all the way up there, halfway through, or you could already be at the target before an important correction, or you might have a little bit more juice, or it could go run up, but it just doesn't make sense, guys. You need these huge patterns. Like Kevin said, the odds, once I got a breakout here, let's say I put my sell stop here. Let's say I bought on that breakout back here. I would put a sell stop here, and my target, my measured move target it would be somewhere up here. Once you get a confirmed breakout, the odds of me getting triggered out there are much lower at the breakout line. I might get a retest of the breakout line, but for me to get triggered out, they're much lower here. Now I'm free floating in the air, and that huge correction, I can't believe people they've forgotten about that. Anybody who bought at 80, 90, 100, 120, they likely got triggered out in this thing there. This is a crazy drop there. So you're more vulnerable for these crazy moves down. The higher up, the more stretch are. Because you got to remember, everybody who bought here in the base, they're in profit taking zone now, right? A whole bunch of people here. Okay, I'm done. I did my 2x. I did my 3x. I did my 4x. I'm out of there. It creates natural resistance. So I don't want to take out too long, but guys, you got to wait for these breakout patterns. That's where you want to enter. I refuse to jump on the bandwagon and tell people buy silver, even if it's going up, because I want to educate people. I don't want to be condescending. Another word, I want to Kevin, find another word there. I don't want to talk down to people, but we want to show people how did Kevin and I had high conviction that silver was going to rocket upwards, because we've studied TA. We've seen these huge patterns often launch these crazy moves. And that was a time to get bullish when we broke out back then. Not now. Of course, silver's still in uptrend. I'm bullish in the sense that I'm still in uptrend, but I'm way less bullish now than I was back then. And that's the message I want to tell people. Look for chart patterns that are exhibiting these 2-3 year bases. Buy those, and then you'll be able to rocket upwards. Don't go in FOMO and jumping halfway through a move or because it's rocketing upwards. There's no safety net. The safety net is much lower. We've had proof of that about like when we had that huge crash down. There's no safety net. Guys, just stay safe out there, please. I don't want to get people upset. I know when I go down that road, people get mad at me. We're still long-term bullish. We still have long-term positions in silver, bullish on our website. Gold, we're still bullish. I'm just telling you, if you're on the sidelines, this is not the entry point there. Did I make enemies? Get rid of friends with this. I don't know what happened, but it's the truth.
There's something else as well you can say about that, is that pattern that we broke out from with gold and silver, that huge base. There are other markets that you can look at right now, today, that are doing exactly that. So if you're wanting to get into an equivalent position that we did in silver, when silver was $23 and gold was $1,800, then just look at the opportunities across the commodity space. Look at energy and oil in particular, because those markets, and those won't be the only ones over the next few years, are presenting opportunities just like silver did and gold did, these low risk, high reward opportunities. We're not saying that silver's, we've already said silver has much higher targets, 250, 300, 500, whatever it happens to be. Gold, 8,000 and then quite possibly 12, 16,000, 20,000. They're all very plausible upside targets. And as Pat said, if you're trading it in a trend following sense, then you're just going to ride that trend and you're going to be bullish until that weakness takes you out of the position. But when we talk about low risk entry points, we're talking about an entry point where the next sort of significant correction is far less likely to see you in a significant loss-making position. Now, of course, had you taken a position in gold at $2,000, I think it broke out and then very briefly went back down to something like, 1960 or something silly like that. And so technically you could well have got triggered out on that. But from a broader point of view of sort of initiating a position and building a position at $2,000, then that was a low risk entry point, because prices moved, at that point it was possible to say there's a high likelihood now of a very significant and accelerated upside move. And we've moved so far that when the next correction comes in, the chances of finding yourself in a loss-making position are far, far lower, of course, than if you don't take your position until now. If you're entering now at sort of $5,000, then it's highly likely that the next correction is going to see you in a loss-making position. So you've got to figure out, as Pat said, am I a trader? Am I an investor? Am I a stacker? What's my time frame? And what's my framework? Because people will come to us and say, Pat, Kevin, should I be jumping into gold and silver right now? When's a good entry point? Well, there's no single answer to that. It depends on those things that I just mentioned. What's your time frame? What's your risk appetite? What are you trying to achieve? Trading, investing, stacking. I do all of those things. I don't just have one approach. I've got what I would call a stacking position, because I've got physical metals, and it's not particularly easy to buy and sell physical metals. So the only time I'm going to be selling those is, right at the end of the gold bull era. I'll take the capital from that and rotate it into stock markets most likely. But so that's a stacking position. And in fact, true stackers, I'm not even a true stacker, because true stackers will just keep on stacking throughout their lifetime for decades, regardless of whether you're in a gold bull era or not. They won't even care if gold is going to go into a 10 or 20 year downtrend. Stackers will just keep stacking and, with a view to handing their metal over to the next generation. So that, that's a true stacker. So I can't really call myself that, but certainly long-term investing. So getting all that fixed in your mind before you even start with all of this stuff is really, really important. It's not to be taken lightly, because otherwise the markets will separate you from your wealth.
I think that makes very clear your approach there when it comes to gold and silver. And I definitely want to make sure that we talk about the oil opportunity. It's one that I've started to hear mentioned more and more. I know you've both been tweeting about it and comparing it to silver kind of at that $25 level. So that's pretty significant. So can we take a look at oil, and maybe you can show me what the setup is looking like there for you?
I'll show my screen there. This is a crud. I call it crud, Kevin, but it's a thicker crud. It's probably for crude, right? For crude oil. Look at this thing, Charlotte. There. Look, remember that chart we showed you on silver, right? At 24, that beautiful consolidation. Well, guess what has been consolidating since 2022? How many years is that? 3? That's 4 years already, Kevin. My goodness. So almost 4 years now, crude oil has been consolidating, doing after a huge breakout here, explosion, sideways move. And look at that. It hasn't quite broken out yet. This is the monthly chart, guys. So you never front run a possible breakout. But if you had an opportunity for something that's going to have less chances. So let's say that's my entry. I entered there. Let's say my sell stops here, and my target's probably going to be all the way up here. Once we get a confirmed breakout here, a monthly close above maybe that dash line, the odds of me going all the way down there to my sell stop are much lower than they are they're just much lower here. I'm more likely to maybe do a back test of this breakout line. And that's the risk. The reward is this. So this is my risk. I might lose this there. But my reward is a multiple of that, 2-3 times higher. And that's an opportunity. And it's also not about just lower risk entry, lower risk of getting triggered out. It's about higher reward. I always forget to say it's always low. I say we're not low risk entry for silver, but what I'm trying to say also is we're not low risk entry, but we're also not at a high reward entry. So the low risk, high reward entries, they're right here out of a 2-3 year base, and whatever. And look at the time it moved. Look at the angle of this green line there. The chances are of us going to that target will be in the shortest amount of time. So if I do the number of length of time that I have to hold this to reach my target, look at the angle of that. Energy in, often energy out. You see it here on the way down. See energy down, sideways move. It did not break to the upside. Look how fast it went. It went pretty much at the same speed that it did into that pattern, right? And after that, it did a repeat here. Here, energy. Well, I'll do it from this energy into there, it went sideways. And after that, when it vomited to the downside, it went really fast. Look, red, 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 red. So now it's the opposite. So that speed here, it's green or hollow candle means up. One red, and month after month after month of green. That's what is likelier to happen once I close above that line. It's less emotional drainage. Month after month, most of the time you're closing green. You don't have to explain to your wife why you're in a drawdown where you're losing money. You have none of that, because most of the time it's just going to explode away after maybe the initial retest. It's just going to explode away from your initial sell stop. It's just beautiful. Mamma mia. I wish that for everybody. Don't FOMO. Wait for those breakout levels. Put your alert, go or join NorthStarBadCharts.com. We got this covered. And that's for us a low risk, high reward opportunity where you enter, the chances of you entering a high rod zone, what I call it returns over time, is augmented, right? Who wants to stay 3 years, 5 years in a play where you make gains, but you're not maximizing your time, right? Time is money. We're not all going to live like elves, like to 5,000 years old there. We have times. Why did I use that analogy? But you know what I mean? We can't. People always say, buy the SPX when it goes up forever. Yeah, over 100, 200 years. I agree with you. But my goodness, it's like, if I'm 50 now, I don't want to wait 10 years for the stock market to recuperate. Let's say we enter a bear market and then I only start making gains when I'm 70 years old. Guys, look, those long-term arguments are kind of nonsense in the sense that with charts, you're able to spot those turnarounds. And now for oil, the opportunity is right on your doorstep. I didn't mention Chevron, Exxon. Like we were in those for the past few months. They've rocketed upwards. They had crazy bases, consolidation patterns, and they're all breaking out. They're probably starting to correct on the daily chart. So folks might have an opportunity once those daily corrections end. But it's unfolding in front of our eyes, and I'm happy you want to talk about this because I think we're the only ones. There's very few people out there that have their eyes on that. Oil could never go up. Drill, baby, drill, whatever, we're going to electric cars. Who cares? Like, I don't care about all that. I just care if the price chart breaking out, is it creating a lower risk, high reward opportunity? And that's all that matters.
Well, and I was going to ask preferred vehicles for getting exposure to oil. So it sounds like some of the larger names in the stocks work. Is there anything else you would mention on that note?
Yeah, well, there are ETFs. I mean, things like XOP and XOM that are in the energy and oil sector. So, there are a number of ETFs. You just, these days go onto ChatGPT and say which ETFs can I get exposure to oil. That's the way I do it, because I'm no guru on all the ETFs that are available, and it depends a bit on which country you're in. I'm in the UK, you're in the States. If you're in different European countries, you have access to different ETFs and different funds as well. And some of them, for example, it's worth mentioning this, I think, here in the UK, we can have self-invested pension plans, which is a bit like your 401ks in the US. So, within those, you will only have access to a predetermined set of instruments. So ask ChatGPT, AI, whatever your AI tool of preference is, and have a look at that, and our members will ask us questions about that sort of thing, about which ways they can play these moves for oil and energy and so on. And we do the best that we can to help. We're not financial advisors, but what I'm saying is do your research. There's lots of different ways you can play these moves with broad-based exposure in funds and ETFs, or in individual stocks and shares like Shell and Exxon and, all these oil and gas companies. So,
those are ETFs that track oil. It's CRUD, USL, USO, or, crude oil futures. Those are the ones, that come to mind. They have different charts. They don't all perform the same, but those are the ones exhibiting those beautiful patterns that haven't broken out yet for the oil. And Kevin's talking about XLE, XOP, OIH, the oil service sector. Those stuff those things are already on the move there. They're carving out higher highs, but there are going to be opportunities in those as they correct on the shorter time frames. There'll be a chance for people to jump on that. They're not super on the longer time frame. Remember that silver chart, how stretched we were historically? Well, the oil plays are nowhere close being stretched historically to anything. So there's no profit taking to take in the oil sector yet, because nobody's made enough money yet to take profits. So that's how it works. Once we start having oil eyes, what is it going to be? It's going to be black eyes. Once we start doing that,
oil gushing out your eyeballs, yeah,
right? Like once that starts happening, then okay, and we'll be stretched probably from the charts, and then we'll have an oil president, whatever. Like once we start hearing that stuff again, then okay, fine, we'll rotate out. But right now, oil is totally undervalued versus SPX, and it could keep getting undervalued, but versus practically everything, oil is.
And also bear in mind that oil stocks do not need oil to be going up for them to be going up. So if you look at the historical charts, a lot of those oil plays will go into really good, bull market uptrends, even when oil isn't really doing anything in particular at all. And not only that, but quite a lot of them are paying you dividends as well. So, you're sitting in a stock that's in a nice bull market and paying you 5, 6, 7% dividends. So, or even more in some cases. So, it's a win-win if you can position in some of these larger companies as well, based on the technical chart breakouts.
That's right. Oil, just a final thought on oil. Back in 2005 or 6 there, I had to recheck again. I did a tweet on that. Oil was, I think, $60 or close to today's price. Silver was $5 or $10. Gold was, I don't know, $500, $600, $800. I can't remember. Even probably less. And silver is like 2, 3, 4 times that price. Gold is 3, 4, 5 times that price back in the 2004 or 5 area. Oil is still the same price and people are scared of higher oil prices. My goodness. Inflation adjusted. Oil is dirt cheap. People have a psychology thing about oil where they refuse to accept that $100 oil breaks the economy. What are we talking about? It was $60 back in 2004. Gold's 5,000. The economy's not broken. Silver's close to $100. People have to stop putting these mental hurdles in their head because somebody keeps repeating it. Higher oil prices breaks everything. Goodness. It's not going to break anything, guys, unless we go to $500 oil overnight. But
it's like saying silver moving from $20 to $120. is going to make it impossible to be making, solar panels or whatever it is. Silver's gone up by a factor of 5, and we're still using silver in just the same way that we were using silver before. And also, just my final thought on oil is that it's important to understand that asset classes move together. So there are really only kind of two main asset classes, I suppose, and those are the ones that follow stock markets and the ones that follow gold, because you're either in a stock market bull era, or if you're not, you're in a gold bull era. And if you're in a gold bull era, you're also in a silver bull era, a commodities bull era, base metals, soft commodities, energy and oil, not at exactly the same time, but whilst gold is in that 10 to 15 year run back in the 1930s, 40s, back in the 1970s, back in the 2000s, during that period, that's when the commodities each take it in turns to have their time to shine. So it could be platinum, palladium, it could be copper, it could be, I'm going to say aluminum, but over here it's aluminium, steel, all of these things, they all take their turn. Yeah. The English language, it's kind of the one thing that divides us, isn't it? English people and Americans. But yeah, you understand what I'm saying, so all of these things move not in lockstep, but they have their gold bull eras during the same period of time. They have their bull eras in the same period of time.
So commodities heading in this positive direction. And just before I let you go, I want to at least briefly touch on Bitcoin, because I know it's another one that both of you have been posting about quite a bit lately. I don't follow Bitcoin overly closely, and our audience is much more on the precious metal side, but even I know the price has really fallen. So can you contextualize what you see coming for Bitcoin, given everything else that we've been talking about today?
Yeah, sure. I'll just quickly give you an idea what the capital rotation process has done to Bitcoin. So capital rotation has really been getting going properly over the last year or two, and it's interesting that, as I said before, priced in gold, the crypto market peaked about 5 years ago, I think in 2021. Now, Bitcoin made a marginal new high priced in gold, but nothing spectacular like in previous cycles. And here you can see, since the capital rotation process has really got going, we've seen silver up a couple of 100% and gold about 100%, the S&P about 16%, and you've got altcoins and Bitcoin down 25, 30%. So, and of course, Bitcoin overall has now fallen 50% from its bull market highs. If you look at Bitcoin just in terms of its own price chart in US dollars, here we've actually got the monthly chart. Quite a lot of the time we've been using the weekly candle chart or the weekly line chart for Bitcoin, but now that we've got several years of price history, we can start getting some important signals from the monthly price chart. And it's very clear to see that any move below about 60,000 for Bitcoin is going to be pretty catastrophic from its technical chart structure, shall we say, because we've got, well, one way of putting it is this: when we have a bull market high and then a bear market low, followed by the next bull market high, when you get the bear market low on a monthly closing basis, it's never been lower than the previous bull market high. So every bear market low on the monthly chart has been higher than the bull market high. So we'll be breaking a structural pattern if we fall below this $60,000 area where I've got these double red lines. If we start falling down to, let's say, $50,000, $45,000, $40,000, a lot of the models for Bitcoin, including the power law model and various others, but particularly the power law, will be broken. to the downside. I think the power law.
What is that power law? I heard that, Kevin.
It's you don't really want to know. It's just basically it's basically on the assumption that Bitcoin is always going to be putting in higher lows, because if you start putting in lower lows per cycle, then it's out of the window. And I don't see any particular reason why you should just assume that Bitcoin is going to forever make higher lows and follow the power law forever. And people in the crypto space seem to have completely forgotten what happened before crypto and Bitcoin existed. They seem to be completely unaware that there are historical periods when stock markets are in a bull cycle and historical periods when gold and commodities are in a bull cycle. And they still seem to be unaware that we've transitioned from the stock market dominating era into a gold dominant era. And as I said before, we have asset classes, and Bitcoin is going to fall either in the asset class for commodities and gold, or it's going to fall in the asset class of stock markets. And so thus far, Bitcoin priced in gold has been mirroring Nasdaq priced in gold, which is an indicator that Bitcoin isn't in the gold asset class, which then leads us onto the next deduction, which is that if we are in a gold bull era, then Bitcoin may very well not benefit from that. So this is what we were saying a year ago. As Bitcoin was around about 120,000, we pointed out the fact that Bitcoin versus gold, and I've got the Bitcoin, in fact, I'll just give you the Bitcoin priced in gold chart. Bitcoin priced in gold was breaking down. Let me just pull that chart up for you, versus XAUUSD. Here we go. So this is the Bitcoin gold chart, and back here in early 2025, and then in the middle part of last year, we were spotting this weakness for Bitcoin priced in gold, and identify that if it didn't break out above that sort of area where the black dotted line is, then something strange was happening, because in every previous Bitcoin bull cycle, you break out above the previous bull market high and Bitcoin completely destroys gold. I mean, look here in this bull cycle, there's the previous bull market high, and Bitcoin in its bull market completely destroyed gold. And in the first cycle, it totally obliterated gold. But when you zoom out and you look at the whole thing, to my eye, I mean, not to the eye of a Bitcoin maxi, of course, but to my eye, that's showing decay. We've got massive gains, less massive gains, smaller gains, and then no gain here from cycle high to cycle high. And so that's somewhat suggestive that as the next couple of cycles come in, we may start to put in lower highs and lower lows for Bitcoin versus gold. That certainly raises that possibility. So, long story short, all of Bitcoin bull markets occur when the price of Bitcoin is above its 50-week moving average. Last time I looked, the 50-week moving average was somewhere around 96,000 or something like that. And all of Bitcoin's bear markets occur below the 50-week moving average. So at the very least, what you can say is that, until we get back above the 50-week moving average for Bitcoin, there's not really much point being particularly long-term bullish. I think there's quite a long way further to go. But I mean, Bitcoin should bounce here. It needs to bounce at 60,000 and perhaps go up to 75, 80, even sort of 85,000. We should get a good bounce here. But until we get back above that 50-week moving average, I would view it as a bear market rally rather than a new bull market that's developed. So using gold as the measuring stick in a gold bull era really helps give us an insight into how an asset is performing, whether it's the S&P or the Nasdaq or Bitcoin or any other cryptocurrency or whatever. Pricing it in gold is far more useful than pricing it in dollars, because we know that the dollar is losing purchasing power rapidly, along with all fiat currencies. So pricing things in gold, it gives a completely different perspective. And for example, tech stocks. Look at the tech sector of the S&P. You might look at some of these tech stocks and think, oh, okay, they're doing all right. Nvidia's doing okay. It hasn't broken down badly yet. But you put all of these tech stocks together, XLK, which is the tech stock portion of the S&P 500, it's in a deep bear market priced in gold. It's in a complete bear. It's fallen something like, off the top of my head, sort of 50% or something. So tech stocks and the tech sector is in a deep bear market priced in gold. You wouldn't know that if you weren't looking at the ratio versus gold.
Well, and I think that takes us kind of in a full circle. So makes it a nice place to wrap up, I think. Thank you so much for both coming on. This was really good.
Thanks for having us on, Charlotte. Appreciate it. And hope your audience enjoys it.
I love it. You let me rant. It's awesome. I'm there. I'm just having fun, expressing myself, and hopefully there's value. Like, I'm sure, look, guys, write in the comments there if you have questions there. We sometimes check that out there on YouTube, but guys, please, it's like, stay safe, be objective, unbiased. It's tough, but charts, they'll help you understand there where it's time to go and time to exit.
Yeah. Amazing. Well, thank you so much. I do love a good rant. And for now, I'll let you go. Once again, I'm Charlotte McLeod with investingnews.com, and this is Kevin and Patrick from NorthstarBadCharts.com.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.